stop everything right now because silver just sent the most powerful signal we've seen in months. And it didn't come from New York, it didn't come from London, it came from China. And what it's telling us should have every silver investor on the planet paying very close attention. Chinese domestic silver prices are now trading at an $8.71 premium over international benchmarks. Let me say that again so it really sinks in. $8.71 per ounce above the global price. That translates to nearly 10%. Nearly 10% more than what you're seeing on your screen when you look at the COMEX or the LBMA. This is not normal price action. This is not a small fluctuation caused by currency movements. This is the world's largest silver consumer telling you, through the most honest signal markets can provide, that they are willing to pay dramatically more than everyone else to secure physical metal. And when buyers pay 10% premiums, they're not doing it for fun. They're doing it because they need the metal. They're doing it because the metal isn't available at lower prices. They're doing it because something fundamental has changed in the supply-demand equation. This is one of the clearest signals I've seen that the paper price and the physical price are diverging in ways that will eventually force a reckoning. And if you understand what's happening, you can position yourself ahead of that reckoning rather than being surprised by it. Now, before we dive into the details of what's driving this premium and what it means for you, let me ask you something. Where are you watching this from right now? Drop your location in the comments below. I want to see how global this audience has become because what's happening in China affects silver investors everywhere. Whether you're in the United States, Europe, Australia, Southeast Asia, the Middle East, or anywhere else on the planet, this story matters to you, so let me know where you're tuning in from. Also, if you're watching this channel regularly and you haven't subscribed yet, what are you waiting for? Hit that subscribe button and turn on notifications. We cover the real dynamics in precious metals markets here, the stuff that mainstream financial media either doesn't understand or doesn't want to discuss. Subscribe and join this community. Now let's get into what's actually happening because the details matter enormously. The current China silver premium didn't emerge quietly. It didn't slowly build over weeks and months. It arrived with force alongside rising industrial demand, tightening supply flows, and stronger positioning by buyers who refused to wait for arbitrage to correct the price. Think about what that means practically. Traders inside China are right now paying significantly more than their counterparts in London or New York for the exact same metal. That price gap of nearly 10% reflects something real. It reflects localized supply tightness that the global market hasn't corrected yet. Now, in normal circumstances, when prices diverge this dramatically between regions, arbitrage traders step in. They buy silver in the cheaper market, ship it to the premium market, and pocket the difference. This activity should, in theory, narrow the gap relatively quickly, but that's not happening. Not fast enough anyway. Why? Because regulatory friction and capital controls can delay that arbitrage process. Import restrictions affect how quickly metal moves across borders. Logistics delays stretch shipping timelines. And while all of these frictions play out, the premium persists and potentially widens. This is not a theoretical discussion. This is happening right now. Chinese industrial buyers are paying nearly 10% above global benchmarks because they need metal and they can't get it at lower prices. That's the market screaming at you that physical supply is tight. Let me break down the demand side because understanding what's driving consumption is essential. China leads the world in solar panel production. This is not a small industry. This is one of the largest and fastest growing manufacturing sectors on the planet. And solar panels require silver, lots of it. The photovoltaic cells that convert sunlight into electricity depend on silver's unmatched conductivity. There is no substitute that performs as well. There is no alternative that manufacturers can switch to when silver prices rise. They need silver, period. When Chinese solar manufacturers ramp up production to meet global renewable energy demand, they consume vast quantities of physical metal. Recent renewable expansion programs have increased procurement activity significantly. Factories are running at high capacity. Orders are coming in faster than production can fulfill them in some cases. And here's the key insight. These buyers prioritize delivery certainty over marginal cost savings. They're not trying to save a few dollars per ounce by waiting for arbitrage to correct prices. They're securing metal immediately, even at elevated premiums, because they cannot afford production delays. When your factory has orders to fill, when your customers are waiting, when your production lines are running, you pay whatever it takes to keep the metal flowing. That's exactly what we're seeing reflected in this premium. But solar isn't the only demand driver. Electronics manufacturing adds further pressure. Silver's conductivity makes it essential for high-tech components. Smartphones, computers, servers, data centers, automotive electronics, medical devices. The list goes on and on. Silver shows up in virtually every modern electronic device in some form. Strong export orders have lifted factory output across China's electronics sector. This increased production reinforces demand strength. And as industrial consumption grows, the global silver market feels the strain. Now let me ask you another question. Have you been tracking the industrial demand story in silver? Or have you been focused primarily on the investment and monetary aspects? Drop your answer in the comments because I'm curious how this audience thinks about the different drivers of silver demand. Let's talk about the supply side because this is where the pressure really becomes clear. Silver supply growth has struggled to match consumption trends for years now. This isn't a new development. It's a persistent structural imbalance that has been building in the background while most investors focused on other things. Many mines face higher extraction costs. Environmental regulations have tightened, project approvals take longer, labor costs have risen, energy costs have risen. The economics of bringing new silver production online have become more challenging. And here's something most people don't realize. Silver is primarily produced as a byproduct of other mining operations. Most silver comes from mines that are primarily mining copper, lead, zinc, or gold. Silver is secondary. This means silver supply doesn't respond to silver prices the way you might expect. A copper mine that produces silver as a byproduct doesn't necessarily increase silver output when silver prices rise. They increase output when copper prices make expansion attractive. Silver supply growth is partially disconnected from silver market signals. This structural feature of the silver market makes it uniquely vulnerable to demand surges. When demand accelerates, supply cannot easily respond, and when supply can't respond, prices have to adjust. The current China silver premium reflects this imbalance vividly. Demand is running ahead of supply, and because supply can't catch up quickly, buyers compete aggressively for available metal, pushing prices higher. Refining and transport constraints compound the problem. When shipping timelines stretch, when logistics bottleneck, regional premiums rise. Metal that exists somewhere in the world takes time to reach the buyers who need it. And during that transit time, premiums persist. Now let's talk about why arbitrage isn't closing this gap as quickly as theory suggests it should. In textbook economics, a 10% price difference between markets creates an immediate opportunity. You buy in the cheap market, sell in the expensive market, and make risk-free profit. Enough traders doing this should quickly eliminate the gap. But real markets don't always work like textbooks describe. Regulatory friction matters. Import quotas affect how much metal can flow into China in any given period. If the quota is exhausted, no amount of price difference will move more metal across the border until the next period. Capital controls matter. Moving large amounts of money across borders, converting currencies, executing trades across different regulatory regimes, all of this takes time and involves costs that aren't captured in simple arbitrage calculations. Physical logistics matter. Silver is heavy. Moving tons of metal across oceans takes weeks. During those weeks, prices can move. The arbitrage that looked profitable when you bought might not be profitable by the time you deliver. Counterparty relationships matter. Established supply chains don't instantly rewire themselves to take advantage of price differentials. Buyers have existing contracts. Suppliers have existing commitments. Changing those relationships takes time. All of these frictions combine to allow silver price divergence to persist longer than pure theory would suggest. And while the divergence persists, it tells you something important about the underlying market conditions. A premium this large, sustained for any significant period, signals that physical demand is outpacing physical supply in that region. It signals urgency. It signals tightness. It signals stress. Now let me connect this to the broader picture we've been discussing on this channel. We've talked extensively about the divergence between paper silver prices and physical silver prices. We've discussed how COMEX and LBMA prices can differ from what physical metal actually trades for in the real world. We've looked at producer premiums, Shanghai vault drawdowns, and the persistent premiums in Asian markets. This China premium of nearly 10% is the latest and perhaps most dramatic data point in that ongoing story. The paper market in New York shows one price. The physical market in China shows a price nearly 10% higher. Both prices are real in the sense that trades are happening at both levels. But they represent fundamentally different things. The COMEX price represents what paper claims on silver are worth. The China price represents what physical silver is worth to industrial buyers who actually need the metal for production. When those two prices diverge this dramatically, one of them is wrong. Either the paper market is too low, or the physical market is in some kind of temporary panic that will correct. Based on the fundamental picture of supply constraints, industrial demand growth, and persistent deficits, I believe the paper market is undervalued relative to physical reality. That doesn't mean paper prices can't stay depressed for a while. Paper markets have mechanisms to manage prices that physical markets don't have. But eventually the physical market wins because you can't run factories on paper promises. You need actual metal. Let me paint a scenario that might help you understand what's happening. Imagine you're a solar panel manufacturer in China. Your factory has contracts to fulfill. Your production lines are running 3 shifts. Your customers in Europe and America and other parts of Asia are waiting for their panels. You need silver to make those panels. Without silver, production stops. Without production, you miss deliveries. Missing deliveries means losing customers, paying penalties, damaging relationships that took years to build. So you call your silver supplier. They tell you supply is tight. Delivery times are extended. The metal you need isn't immediately available at the global benchmark price. What do? You pay the premium. You pay $8, $9, whatever it takes to secure the metal you need to keep your factory running, because the cost of that premium is far less than the cost of shutting down production. Now multiply that scenario across dozens of major manufacturers, all making the same calculation, all paying whatever it takes to secure supply. That collective behavior is what creates and sustains premiums of this magnitude. It's not speculation. It's not manipulation. It's industrial buyers with real needs competing for limited supply. Now here's the question that matters for investors. Is this premium temporary or structural? If it's temporary, prices in China will eventually fall back toward global benchmarks as arbitrage flows increase and temporary bottlenecks clear. The premium represents a short-term dislocation that will correct. If it's structural, it suggests a more permanent shift in the silver market. It suggests that the old relationships between regional prices are breaking down. It suggests that physical silver is entering a new regime where traditional pricing mechanisms no longer adequately reflect true supply and demand conditions. I lean toward the structural interpretation, but I want to explain why with specific reasoning rather than just assertion. The industrial demand drivers are not cyclical. Solar manufacturing is growing because of long-term energy transition policies adopted by governments around the world. Electronics demand is growing because technology continues to penetrate every aspect of modern life. Electric vehicles are proliferating. Data centers are multiplying. 5G networks are expanding. All of these trends require silver. All of them are multi-year, even multi-decade in duration. They're not going to suddenly reverse because prices rise 10 or 20%. Meanwhile, supply faces persistent headwinds. New mine development is slow and expensive. Byproduct dynamics limit supply responsiveness. Existing operations face rising costs. There's no cavalry coming to suddenly flood the market with new production. When you have structurally growing demand meeting structurally constrained supply, premiums aren't temporary. They're signals of a new equilibrium where buyers must pay more to secure metal. The China premium of nearly 10% may narrow somewhat as short-term frictions ease, but the underlying forces that created it aren't going away. And that suggests we may see persistent premiums become a normal feature of the silver market rather than an anomaly. What does this mean for investors and traders? If you own physical silver, this is validation. The premium being paid in China confirms that physical metal has value beyond what paper markets indicate. Your holdings are worth more to actual users than screen prices suggest. If you own paper silver through ETFs or futures, you should understand the distinction between what you own and physical metal. In normal times, they track closely. In stress times, they can diverge. Knowing which you hold matters. If you're considering adding to silver positions, the China premium suggests the risk-reward remains attractive despite already elevated prices. When the world's largest consumer pays 10% premiums for immediate delivery, it tells you demand is real and urgent. If you're trading shorter time frames, watch for signs that the premium is narrowing or widening. Changes in the premium can precede moves in global benchmark prices as arbitrage flows respond. Now I want to address something important: currency dynamics. Some people will argue that the China premium is just a currency effect. The yuan moves, it creates apparent premiums or discounts, and it doesn't really mean anything about physical supply and demand. Let me explain why that argument doesn't hold here. Yes, exchange rate movements can influence local precious metal pricing. Small currency fluctuations do exaggerate or compress local premiums. This is normal and expected, but the scale of the current China premium far exceeds what currency movements would explain. We're talking about nearly 10%. The yuan hasn't moved 10% against the dollar in recent weeks. The premium cannot be explained away as a currency artifact. This is a physical market phenomenon. Real buyers are paying real premiums because real supply is insufficient to meet real demand at global benchmark prices. Currency provides the lens through which we measure the premium, but currency is not creating the premium. Supply-demand imbalance is creating the premium. That distinction matters enormously for understanding what this signal means. Let me ask you another question. How are you currently positioned in silver? Do you own physical metal, paper claims through ETFs, mining shares, a combination? Drop your answer in the comments because I want to understand how this audience thinks about different ways to gain silver exposure. Now let me talk about what happens next because that's ultimately what matters for positioning. Scenario 1 is that the premium persists or widens. This would happen if supply continues to lag demand, if logistics bottlenecks remain, if industrial consumption continues growing faster than metal can flow into the region. In this scenario, eventually global prices would need to rise to attract more supply into premium markets. The China price would pull global prices higher. Scenario 2 is that the premium narrows as arbitrage flows increase. More physical metal gets shipped into China. Supply temporarily catches up with demand. Premiums compress toward historical norms. This would suggest the dislocation was temporary rather than structural. Scenario 3 is that both China prices and global prices rise together. This would happen if the premium sparks recognition that silver is undervalued globally. International buyers see the premium, realize physical is tight everywhere, and start paying up themselves. Premiums converge not because China prices fall, but because global prices rise. I think scenario 3 is most likely over time. The fundamental picture supports higher prices globally. The China premium is simply the most visible symptom of an underlying condition that affects the entire market. But I want you to have all three scenarios in mind. Markets can surprise you. Being prepared for multiple outcomes is better than being certain about a single prediction. Now let me bring this back to the practical level. If you're watching silver prices and wondering whether the current levels represent opportunity or risk, the China premium provides important context. When industrial buyers with real needs are paying nearly 10% above benchmark prices, it suggests the benchmark is understating true market value. It suggests that the path of least resistance for global prices is up rather than down. That doesn't mean silver can't pull back in the short term. Markets are volatile. News events can trigger selling. Technical levels can create resistance. All the normal forces that create short-term price movements still apply. But the structural picture, as revealed by premiums of this magnitude, supports higher prices over time. The demand is real. The supply is constrained. The imbalance is persistent. Now, I want to share something about how to think about signals like this China premium. When markets send strong signals, it's tempting to either ignore them or overreact to them. Both responses are mistakes. Ignoring the signal means missing important information about market conditions. The premium exists for a reason. Understanding that reason helps you make better decisions. Overreacting to the signal means making impulsive decisions without proper analysis. The premium doesn't necessarily mean silver goes to $100 tomorrow. It's one data point among many that informs the overall picture. The right response is to incorporate the signal into your analysis, update your view accordingly, but maintain discipline about position sizing and risk management. The China premium tells me that the bullish case for silver has been strengthened. It tells me that physical demand is even more robust than I previously understood. It tells me that supply constraints are biting harder than benchmark prices reflect. But it doesn't tell me exactly when or how the market will correct this imbalance. It doesn't give me a specific price target or timeline. It simply adds weight to one side of the probability distribution. That's how you should think about signals like this, not as certainties, but as evidence that shifts probabilities. The China premium shifts probability toward higher prices. How you express that in your positioning depends on your individual circumstances, risk tolerance, and investment time frame. Let me talk about something else that connects to this story. The broader precious metals complex. Gold has been making headlines with strong performance. Gold prices have been elevated, pulling back slightly on profit-taking but maintaining strong levels overall. The gold market has been responding to tariff uncertainty, geopolitical tensions, currency concerns, and all the other factors we've discussed in previous videos. Silver has been reaching toward key resistance levels. The $90 level has been tested. The consolidation range between 70 and 90 has been playing out. The market has been rebuilding confidence after the traumatic crash several weeks ago. The China silver premium adds to this picture by confirming that physical demand for silver remains extremely robust. While gold gets the headlines, silver is showing signals of even tighter physical conditions. Some analysts track the gold to silver ratio as an indicator of relative value. When that ratio is high, silver is cheap relative to gold. When it falls, silver is catching up. The existence of nearly 10% premiums in China for silver suggests that on a physical basis, silver is even more undervalued than headline ratios suggest. The paper ratio uses paper prices. The physical reality involves premiums that make silver relatively more expensive than paper prices indicate. This is another dimension of the paper physical divergence we've been tracking. Not just absolute price divergence, but relative value divergence. Physical silver is commanding premiums that physical gold is not commanding to the same degree. That tells you something about which metal is tighter in the physical market right now. Before I wrap up, let me give you specific things to watch in the coming days and weeks. Watch inventory data, Shanghai Futures Exchange stocks, Shanghai Gold Exchange stocks, COMEX registered inventory. Any of these showing continued drawdowns would support the tight supply narrative. Watch the premium itself. Is 871 expanding or contracting? Changes in the premium are leading indicators of changes in market conditions. Watch physical import data. When trade statistics show flows of silver into China, that's arbitrage working. Heavy flows would suggest the premium is attracting metal and may soon narrow. Light flows would suggest frictions are keeping the premium elevated. Watch industrial production data. Any signs that solar manufacturing or electronics production is accelerating would support the demand side of the thesis. Any signs of slowing would suggest demand pressure might ease. Watch how global benchmark prices respond. If COMEX and LBMA prices start rising toward Chinese levels, that's the physical market pulling paper prices higher. That would be a bullish development for silver overall. These indicators will help you understand whether the current premium is resolving or persisting. Use them to update your view rather than simply holding a static opinion. Now let me close with some perspective on what this all means. We're living through a period where the old relationships between markets are being tested. Paper prices and physical prices are diverging. Regional markets are showing different valuations for the same underlying metal. Industrial demand is growing faster than supply can respond. These conditions create both opportunity and complexity. Opportunity because dislocations eventually correct, and those who understand them can benefit. Complexity because the timing and manner of correction is uncertain. The China silver premium of nearly 10% is one of the clearest signals we've seen that physical conditions are stressed. It's one of the most powerful validations of the tight supply thesis that bulls have been discussing. It's one of the most important data points for understanding where silver might be headed. Whether you're a long-term holder, a short-term trader, or someone still deciding whether to get involved, this signal deserves your attention. The market is telling you something important. Are you listening? Silver is a market that rewards patience and punishes impatience. It rewards those who understand fundamentals and punishes those who chase headlines. It rewards proper risk management and punishes leverage at the wrong time. The China premium doesn't change those eternal truths about the silver market, but it does provide evidence about which direction the fundamental forces are pointing, and right now they're pointing toward tighter supply, stronger demand, and higher prices. What you do with that information is up to you. Now before I go, let me remind you to subscribe if you haven't already. We cover these kinds of signals every week, helping you understand what's really happening in precious metals markets. Hit that subscribe button and turn on notifications so you never miss an update. And share this video with someone who should be paying attention to silver. The China premium story isn't getting mainstream coverage. Most investors have no idea that industrial buyers in China are paying 10% more than global benchmarks. Help spread the information to people who need it. Now here's my question for you to answer in the comments. Do you think the China premium is temporary or structural? Do you think it narrows over the coming weeks, or do you think it persists or even widens? I want to hear your analysis. The signals are clear. The physical market is speaking. The premium exists for a reason. The question is whether you're paying attention and positioning accordingly. This is Mr. AG Asian Guy. Stay sharp out there.